Welcome back to Click Capital, your go-to channel for daily fundamental and technical analysis of the markets. And if you are new here, hit that subscribe button with the notifications and you'll get notified every day when these videos are released, as I post them a couple hours after market close, and I go through the same process every day. And if you follow along with that process every day, I promise you'll have a better feel of the markets and be able to make better trading and investment decisions, as you'll have a more intuitive sense of where markets are and where they could possibly go next. Okay, so let's dive right in. So we closed flat today on the SP 500 at 41.33, managed to close the week slightly red, but only down 4 points. That was after 5 green weeks in a row, which was the longest string of green weekly candles we've had since the start of the bear market. And there's signs that we may have stalled out up here. As we can see, we are right in the middle of a big resistance zone where price has turned before back in late January and a little bit lower at 4100 in late November, again in mid-September, a little bit higher in August. We turned here in May last year, and we actually found support at this level in March last year. And even back in May in 21, we found support around here. So this is a pretty big zone where we're at, and price and volatility is coiling up. And typically before markets turn, they tend to stall out, lose momentum, and consolidate. And we can see that with the decreasing moves up in these swings we've had. If you look back in June last year, the swing up from that low to the high was 18.7%. Then again from our October swing up, we got to 17%, and then the next swing up we had from January to that February 2 peak was 11%, and since we bottomed again on 13 March, we've only swung up 9.5%, so the market is losing momentum here. And there's many other indicators as well pointing to the fact that the market is losing momentum and we may turn downwards. We've got a big divergence here on our hidden divergence indicator. You can see since the 31st of March, price has climbed, but our indicator has turned downwards and is in a negative territory. Also, we're diverging from central bank liquidity as shown by this yellow line here. So global central banks have begun tapering their balance sheet once again, which does correlate with the stock market as it has done since COVID a lot. So that will act as a big gravitational weight on the market as well. Also, we're seeing the SP 500 diverge with other closely correlated markets as well. This is a chart of the SP 500 equal weighted ETF RSP, and we can see here with the orange line being the SP 500, the gap that we've got between these two markets, indicating that the market is losing breadth. And we can see that on the chart of the amount of stocks above their 200-day average, currently at 56%. We got up to 75% when the market last peaked on February 2nd. And even though the S&P 500 is just slightly below that, we can see that loss in breadth. So this time around, when we're back up here above 4100 on the S&P, there's just significantly less stocks above their 200-day average. And we can see that again in the amount of stocks making new highs here on a chart of NYSE new highs. We can see that actually created a big divergence in late 21 when the market lost a lot of its breadth, even though the S&P 500 was continuing to climb. And the amount of stocks making new highs is tracking firmly sideways. We've got no bullish divergence or anything in there or anything like that. And we'd really need to see this start to uptrending again for us to start confidently saying we're in a new bull market. And another good measure of risk sentiment is the spread between high yield bonds and treasury bonds of a similar duration. That can be a good indicator of what the bond market thinks of risk out there, which is typically more sophisticated market than equities. And here we're looking at a chart from the October 13 bottom in equities. And we can see here we've got the biggest gap between the orange line S&P 500 and that spread. So versus the bond market, equities are a bit technically overvalued here with their view on risk. Another key market we want to pay attention to is the dollar index, and this is an inverted chart of the dollar index with the S&P 500 overlaid on top of it, and we can see it's had quite a bit of correlation this last 6 months, and they're roughly at the same levels here. So no divergence with the US dollar, and if we just go back down to a normal weekly chart of the US dollar index, we can see we're at a big support level here around 101.50. So if we were to lose that support, that would be bullish for stocks. However, if we were to find support here and rally back up, that would be bearish for stocks. Another key market to pay attention to is the US government bond 10-year yield, and I've inverted that on this chart as well and overlaid with the SP 500. You can see we've got a bit of correlation there, as typically when rates go down then stocks go up, and you can see here when rates went up from 340 towards 4%, stocks fell as well, and vice versa. And so right now stocks are a little bit above where they are relative to the 10-year, so that's another key market to pay attention to. And back down to the weekly chart for the 10-year yield, we can see that too, like the dollar, has a major support zone just under it here around 340. We have bounced off it this week, and if rates were to continue climbing higher, that would be bearish for stocks. However, if we went back down, that would be bullish for stocks. Okay, so we'll come back to the charts soon and go through all the major markets today, but first let's hop on over and have a look at some data. And much the same all week, another flat, low volatility day, pretty mixed out there. Apart from a few standouts like Procter & Gamble, Amazon, Eli Lilly, we did see the defensive sectors perform a bit better today than the rest, with consumer defensive, utilities, and healthcare holding up pretty good. And once again, mega cap tech seems to be stalling out, which I'll get more into on the charts later on. And it appears the economy still is holding up. We had those PMIs come in today, and they came in a little bit better than expected. And since they're above 50 levels, that indicates businesses are still in an expansive territory. And the fear and greed index is little changed at 64. And if you look back over the last couple of years, every time the fear and greed index, this blue line here, went above 60, it was associated near a short-term market top in the S&P 500, indicated in this orange line. And dark pool buy has taken a backseat to this action as well, indicated by the blue line that is decreased in contrast with the S&P 500 shown here in the green line. And corporate insiders are not buying their stock here. And in fact, we got the third lowest reading yesterday over the past year, with only 19 purchases being recorded against 72 sales. And you can see over the course of this year the increased corporate sales as company insiders have been selling into this rally. And with that low volatility, options market really wasn't busy today, considering it's the third Friday of the month and regular monthly options expiry only came in at 38.8 million contracts traded versus an average daily volume of 40.2 million. And once again, there's a few more calls being purchased. And in continuing similar pattern, we're seeing 87% puts in high yield bonds being purchased, but still low amount of puts in the mega cap tech. We can see Amazon 27%, Nvidia is the exception at 55% puts, and Apple 45% puts, Microsoft 41% puts, and Google 24% puts. So still a lot of people buying calls on mega cap tech up here. And a Fed hike of 25 basis points at the May meeting looks like a sure thing, with current probability from the Fed Fund futures market at 89%. And we can see now in the June contract there's a 23% chance that we get another 25 basis point hike in June, and that was only at 16% a week ago. So the market is increasingly pricing in that the Fed is going to get back into hawk mode and increasing rates again, especially if economic indicators are holding up, along with the stock market as well, and jobs market gives every reason for J-Powell to keep hiking rates. And that, along with declining central bank liquidity, should put a pretty good roof on equities and other risk assets climbing too much further. And continuing jobless claims has climbed back to pre-pandemic averages, above 1.8 million. So the jobs market is trending towards a recession here. We've got the unemployment rate at 3.5%. We really need to see that tick above 4% to significantly increase the chance that a recession is just around the corner. And something that makes me feel good about my short Nvidia position for me and my clients is seeing The Economist's latest magazine cover with the letters AI on it. And that's because the magazine cover indicator has to be one of the most strongest contrarian indicators out there. You can look back over 100 years and time again, the magazine covers just seem to be really good at bringing attention to a theme or market trend right at its peak. And that's because by the time journalists at these magazines write a story, the trade has usually already been gotten because everyone's talking about it, and that's why they write a story about it, because that's what's going to sell the most amount of magazines. And here's one of the most famous ones by Business Week in '79, The Death of Equities. After stocks had been going sideways for about a decade due to high inflation, it was almost near the low of what then went on to become a 40-year bull market in stocks. So many studies have been done on this, and it's been proven time and time again that magazine covers are usually a great thing to fade. Here's one from late 1999, GetRich.com. And another one here near the peak of the housing bubble in 2005, Home Sweet Home. And even as recently as in May 2020, when Time magazine compared the unemployment back to the Great Depression in the 1930s, when stocks actually fell close to 90% from their peak. But we all know what happened during COVID lockdowns with the Fed unleashing an unprecedented amount of liquidity into the markets and sending stock prices rocketing higher. So again, that's a good sign that magazines like The Economist are talking about AI, which means we are probably closer to the top than the bottom in this hype train. And Apple insiders continue to offload stock, and that was in addition to CEO Tim Cook a couple of weeks ago, who sold almost $10 million worth of shares. And this is a trend we're seeing amongst a lot of tech stocks with insiders dump it, and they typically have a good record at selling tops that we've seen over time. And famous long-time retired bond investor Bill Gross has been buying up some regional bank stocks. He said he purchased Western Alliance, Synovus, PacWest, as well as the regional banking ETF. And he said since shares of small lenders have slumped, trading at a discount of about 60% of the value of their net assets, that, together with a return on equity of around 10%, provides an enticing long-term investment. And he thinks some of these smaller regional banks might be gobbled up by larger players at a premium. And we're seeing the same things too, and that's why we this week added a small regional bank to our portfolio for our clients as well. If you'd like to know what stock that is and what other stocks we're holding, click the link below this description, and you can follow our equity long-short strategy in real time over on the Collective 2 platform. And an economist I have a lot of respect for is Mohammed El-Iran. He warns of a recession, Fed-triggered financial accidents, and commercial real estate's moment of truth. And he has a great way of breaking down complex issues into simple to understand language. And he said, having started late in addressing inflation, the Fed has been forced into a highly concentrated set of rate hikes that have not only enormously narrowed the path for a soft landing, but have also increased the risk of both recession and financial accidents. He sees inflation being sticky as well, around 4 to 5%, and he sees banks are reducing their loan books due to the loss of deposit and capital pressures. As such, this increases the likelihood of an economic slowdown. And in relation to commercial real estate, he said, whilst previously in a low interest rate environment, a lot of those big deals, with the sudden increase of rates and the fact that $1 trillion of commercial real estate needs to be refinanced over the next several quarters, that could be the nearly perfect storm. And I agree, I think that's a tail risk in the markets that we've yet to see how it's going to play out with this commercial real estate. And who knows, it may turn out to be a nothing burger, or it may start sparking fears of contagion, especially if rates keep marching higher towards 6% and those vacancy rates in office buildings stay elevated as well. Okay, that's a look at today's data. Let's head back on over to the charts. And global equity breadth looks to be stalling out as well, as we can see on international indices, TSX, the FTSE, the DAX, the Nikkei, the Aussie 200, and the China 50, turning sharply downwards below its 50 as well. And volatility is really coiled up here with the 16 handle on the VIX. However, that's in contrast to volatility, the VVIX index, which isn't near its lows. And volatility risk premium with implied volatility well above realized volatility here, implying that we may be near a low on volatility. Bond market volatility continues to trade at near record levels versus stock market, as indicated by the MOVE VIX spread. And this is a 3-month chart going back to 2002. The only time we've been higher was back in the GFC in October 2008. Not much fear out in the market there, with the put-call equity ratio at 0.86. However, the cost of tail risk insurance is still a little bit elevated, with the skew index at 132. Breadth looks to be losing its footing, with stocks above their 20-day average slipping down to 68%. And gross cyclical sectors versus defensive sectors continue to slip as well. High beta stocks versus low volatility stocks continues to trend down. And for the first time since early January, tech stocks actually slipped below their 50-day VWAP versus SP 500 stocks, and setting right at that level, indicating the trend may have changed on this tech outperformance that we've been seeing all year. Small caps still trying to find a bottom here versus large caps. Commodities and gold have been pulling back relative to stocks, and international developed stocks are still performing well versus American stocks, with European stocks actually close to breaking out to new yearly highs versus American stocks. The 10-year, 2-year yield curve is sitting flat at negative 61 basis points, and with that economic data holding up, that's probably going to stay around these levels, and we want to see this go back into positive territory to confirm that their recession is just around the corner. High yield had a little pop-up today versus treasuries, but you can see we're still nowhere near the February 2nd when stocks last peaked, as this spread chart is diverging from stocks. 2-year bond yield is holding ground there just below 420. and the 10-year as well, just above 350. Volatility looks to really come out of the bond market. We've got June Fed Fund futures here at 509 and really coiling up, along with a September contract at 503. And the bond market's still forecasting the Fed to decrease rates later this year towards Christmas at 4.67%. However, you can see with the June contract at 509, the market is pricing in a little bit of a probability that we're going to get another rate hike in June after the hike that we're going to get next month as well. 20-year Treasury bond ETF got above its 50 today, but ended up performing a bit of a bearish engulfing pattern here. And suspect this may continue trading sideways as there's large forces on both sides. There's the safety of treasuries and the flight from deposits, but we've also got increasing rates, which should put a bit of a lid on this going higher as well. As we remember that bond prices and yields are inverted. Still got the dollar index consolidating here at this big support zone, and Bitcoin looks to have lost its footing from its big resistance zone around 30,000. We can just go out to a weekly chart here. And that's not good price action, rejecting off this big resistance zone here. You can see we've turned here a bunch of times before. So it looked like the crypto market could not get legs and find itself above 30,000. We can see that with Ethereum as well, rejecting off. We'll be next looking to see if they can hold their 50 bars to see if this uptrend is still intact. But don't forget that we really saw this uptrend start after the failure of Silicon Valley Bank. That's what really lit a match under Bitcoin, as fears of contagion in the traditional financial system and deposit runs into harder assets saw Bitcoin rally. However, with the banking sector really cooling down and volatility cooling down and rates moving back up, it looks like crypto market is starting to catch up with that reality as well. Commodities continued their pullback today, but they are still above their 50 bars, and gold as well, just below 2,000 an ounce. And if we go out to a monthly chart on gold, I've got a feeling we could come back and test this 1,900 an ounce level, as a lot of people have been looking for the breakout in gold, so we may get a little bit of a shakeout here and retracement back to 1,900. Which I do expect to hold as support. And I do continue to be a long-term bull on gold. But due to the fact it looks like we may have a short-term pullback here, I have slightly reduced our gold exposure in the portfolio. Nutty gas still trending sideways, putting in a long bottoming formation. Over to stock sectors, pretty mixed out there today. We did see tech come off a bit, especially semis down 1% and look to be losing this big resistance zone up here. We also see energy, oil, materials and gold come off, along with financials and industrials. And the defensive sectors perform well today. You can see healthcare here gapped up 0.67%, staples up 0.72%. That was with Procter & Gamble helping that, and utilities as well holding on really strong. So a definite rotation into defensive stocks that we've seen here over this last couple of weeks. And the BlackRock barometer, an indicator I look for the health of the stock market, came off 2.2% today on above average volume, and I'll be looking to see if this can hold its 50 as well. JP Morgan and the big banks holding themselves up here. Tesla had a little rebound here today, but we did lose that low from March and back here in November yesterday on that huge volume gap down after a disappointing earnings. And since their quarterly earnings were down 20% versus a year ago, they may not deserve this 45 PE. So I suspect that Tesla's stock price will come in and fill this gap from Q4 earnings and take us down to 146, where we may find support down there, but we'll just have to assess the price action if and when that happens. And Nvidia found lower lows and lower highs today on this continuing bearish divergence, and this is a core short position in our portfolio that we plan on to hold for many more months to come. And another of the market's most important stocks is Apple, so we can look at the price action on Apple for clues as to where the market will go next, since it makes up such a large percentage of the SP500 and NASDAQ indices. We can see on a weekly chart it is stalling up here at a big resistance zone, and back down on the daily chart it is forming a bearish divergence as well. The same as Nvidia and Microsoft, a similar story as well. You can see on our hidden divergence indicator we've got a big bearish divergence forming here, and price is stalling out around this big resistance zone. So probably the four most important stocks in this market in terms of weighting and sentiment and market psychology. You look at Tesla, price action below its 50 here. Nvidia with its bearish divergence lost momentum. Same with Apple, same with Microsoft. So that's an under the hood look at the price action of the biggest, most important components of the indices. And they all look to be putting in topping processes. Amazon was the exception today, up 3%, but that had been beaten down a lot more than the other mega cap techs over the past 6 months, and that's still coming up to a resistance zone here as well. Another large company, Google, stalling out in its resistance zone too. Meta's pulling back with lower lows and lower highs, and AMD calling up underneath its 50 as well. Netflix right at its 50. Not much to report in meme stocks today, pretty mixed, but we did see C3AI lose this support zone that I was talking about yesterday and traded under $20 a share. So it's possible that we may have seen the top on this thing, and this could just be one big topping formation. And we go out to the 3-day chart. This AI hype rally that started in early January, we may have seen the peak of it as these smaller AI stocks, kind of the high beta, canary in the coal mine play on these things. And this is technically breaking down, losing major support. And with the Economist cover of AI, I'm confident that we've seen the top in this AI hype. And what caused the staple sector to rally today was Procter & Gamble coming out with their earnings a little bit better than expected, and they gave good guidance as well. And as we all know, they sell mostly staples, so the consumer is still out there and still spending as everyone still has a job. Railroad operator CSX came in a little bit better than expected as well, and the market liked that, so the economy is still moving along. Bit of a recovery here in AT&T after that huge sell-off yesterday, up 3.2%. And the most vulnerable regional banks trading well as well, with PacWest above its 50 now, and Western Alliance as well. And the big banks looking to be having a bit of a breather here, with Bank of America, Citigroup, and Wells coming off a little bit today, but they did find some dip buyers. Schwab as well, consolidating just under its 50. Okay, that's a bird's eye view look at all the major market categories. Let's go back to the main indices for our final outlook. And if you've been watching the channel, much the same thoughts as all week. I continue to believe that we're putting in a topping formation here, and just all the indices look weak. We can see the equal weight SP500 trading really flat on our divergence. The NASDAQ as well, consolidating, looks to be losing footing here on a divergence. The Dow stalling out, and small caps acting weak as well. And I think a big red candle is just around the corner. I'm not sure exactly what will cause it, but I think we are overdue for a bit of a correction and sell-off, and I'm positioned for that in my personal swing portfolio, and I've increased my net short to 60% net short of the portfolio. And as always, I'll be watching the indicators every day and reassessing every day to determine my positioning. Okay, that's all for this week. Thanks very much for tuning in. I hope you found some value in this video. Hit that subscribe button if you did, and if you want to get access to all of our custom indicators, just head on over to our website, clickcapital.io. Go to the indicators page and you can have a look at all our indicators, and you can buy them individually, or you can save $200 and get all 13 of them. And these are unlike any other indicators you've seen out there. We've developed these over the last 8 years. I've been on TradingView, and we use them in our own trading and to manage our client portfolios as well. And these aren't just technical indicators. Some of our indicators use fundamental data to work out what a fair value is for a stock, the business quality score, the risk a stock may crash, and what kind of mood the market is in, based on things like market breadth and VIX futures term structure. We also have other things that can help you make better trading decisions, like seasonality forecast and our smart sizing indicator that can show you how many shares you should buy depending on your account size and the stock you're trading, along with your risk objectives. So check them out. I'm sure you can find some value in them, and we offer a 7-day money-back guarantee if you change your mind. And we accept payments through PayPal or with your credit card through Stripe, so it's all very safe. Other than that, I wish you a good weekend and hope to see you again on Monday afternoon. Take care.